Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand what we see in the global stock market, bond market, and all the investment sectors around the world so you can better position not only your money, but also understand why we make changes, when we do, and how they impact your portfolio. You know, we continue to see information that's coming out around the world, not just the U.S., but of course in the emerging markets like India, China, Brazil, of course Russia, areas like that. We're also seeing, you know, obviously developed nations like the Eurozone and the U.S. all showing substantial signs of slowdown. We got new information again this week. The purchasing managers index PMI again flashed another negative. We're seeing a global slowdown. Apple reported earnings yesterday. They missed by the mark. Now there's a couple reasons why Apple missed, but I want to talk just a little bit about Apple and how it relates to the U.S. stock market. I'm also going to talk about our market trend indicators, and I'm going to talk about how we're currently positioned within our client portfolios and what we think we're going to be doing shortly if some of this continued weakness occurs. First, a little bit about Apple. I look at the S&P 500, which is positive year to date, but it's slowing down and starting to roll over, but it is positive. The Dow's slightly positive, and the NASDAQ's more positive, but the NASDAQ also slowing down. The majority of the returns, because we have capitalization weighted indexes, the S&P 500 and the NASDAQ, and since Apple Computer is the largest component, and since Apple has actually done very well this year, in value, it actually has gone up 50% year to date in share price. It has contributed a tremendous amount to the NASDAQ return and the S&P. If you actually strip out Apple, your returns on not only the S&P but NASDAQ would be very slim at best. So what I'm saying is we have a very, if you look at the indexes, it's really almost been run by one horse, which is Apple generally speaking, and it's kind of kept those indexes up or higher. Apple is starting to falter. The biggest reason is I think a lot of people are waiting for iPhone 5 to come out, which won't be till next year. So I think the next couple quarters for Apple are going to be a little bit weaker. Not that they're not growing, but it's going to be weaker than expected. I still think Apple as a company is great, but I think it's starting to break down a little bit, and it could go lower before it has another chance to go higher. But now I look at the general economy and the market. Things are greatly slowing. I said back in July 8th on my radio show that Sunday, and I'm going to make this call again so it's public, I think we are already in a recession. Your government's not going to call a recession for at least 6 to 9 months, but I think we are already in recession. Europe is definitely in a recession. Again, you're going to see official calls on all this stuff across the board. We saw numbers that came out today on GDP growth that were horrifically bad over in Europe. We're seeing interest rates, generally speaking, on the 10-year in the U.S. hit a record low yesterday. Now, I called, again, on that same Sunday, I called for a 10-year in the U.S. on the Treasury at 1%. I think we're going to hit that within the next 6 months or less. And I think we could actually go lower than that on interest on the 10-year in the U.S. Treasury. By the way, Japan right now is under 0.75%. It's been there for a while. So when people say interest rates can't go any lower, they possibly can. And so essentially what we've seen is interest rates in more what's perceived to be more stable economies like the U.S. interest rates have actually come down because we're the safe harbor of capital where people are looking to take money off risk assets. And then you look at places like Italy and Spain, which hit record numbers on their 10-year yesterday. In fact, if you look at Spain, they're over 7.5%. That is becoming real worrisome. Italy's well over 6.5%. So at the end of the day, what we basically have is this. There's a lot of rumors out there that Spain now is going to be looking for a complete disaster relief plan, meaning they're going to look to bail the whole entire country out, which the EU and the funds they currently have are not enough money. I think Italy will be next. I think the bottom line is the peripheral countries around Europe are really falling apart. And at the end of the day, their economy is slowing. Numbers coming out of China are slower. They weren't quite as bad as anticipated. And if we look at their numbers, generally speaking, they were just a tad less than the 50% mark, meaning 50% is less than 50 is contraction, 50 is break even or up. So they're still in a contraction mode, and generally speaking, I think China will be slower than most people anticipate over the next 2 or 3 quarters. They're trying to reinflate their economy by doing some stimulus, and so is the US, and so is all of these other countries. That's why if you look at, generally speaking, most interest rates are at rock bottom prices, but they could go lower. Now, all of the stimulus hasn't really created jobs, hasn't really done anything to grow the economy, and we're kind of on this sugar high or heroin high. And at the end of the day, if our government keeps printing money, keeps doing the things, and it hasn't worked before, we're kind of getting ourselves into a bigger hole. So hence the reason why our portfolio became more and more defensive starting about 3 months ago. Our market trend indicators on almost every country-specific sector, not the S&P 500, which is the U.S., and again, it's been kind of propped up by Apple. If I took Apple out of the S&P, I could pretty much guarantee you that our market trend indicators would be negative on the intermediate, short-term, and long-term for our direction of the S&P 500 or the U.S. stock market. But it's in there. So the fact is, we did hit a short-term intermediate indicator sell yesterday. I don't think the long-term is going to come yet. We'll have to have some more sell-off of the market. But in all the other countries we look at, China back in March indicated a sell in our intermediate, short-term, and long-term market trend indicators. India, Brazil, Russia, I can go on and on. Bottom line is, the U.S. is the cleanest, dirtiest shirt in the laundry basket, and it's kind of held up, and a lot of money has gravitated here as kind of a place where they feel, well, things are a little bit more stable. If the economy really starts to get slower, I fear that the stock market's going to go down more. If the recession does get worse and things get worse and the government doesn't do what's really correct on a fiscal responsibility, not this printing of money and doling out all this stuff that they're basically doing, but ultimately fix the deficit problem, get a balanced budget, and really start growing the economy and jobs, we have a chance, obviously, to bounce off the market and start going higher. I don't think that's going to happen before the end of this year, I'll be honest with you, but we're going to let our global tactical opportunity portfolio dictate our changes, meaning relative strength of any sector. Equity-based markets across the world have becoming weaker and weaker against safer assets like treasuries, like corporate bonds, and the like. That's why in our portfolios today, we continue to hold high-yield bonds, corporate quality bonds, long treasuries, publicly traded REIT, and emerging market bonds. Now, those positions can change at any time, and they're still all within our global tactical 5 position. But again, at the end of the month, things could change, and we may take one of those positions out, a different position may be added. We actually may be raising some cash if cash actually gets stronger. So we're pretty defensive right now, and it's serving our clients well. In fact, I kind of looked at the numbers month to date, and our full growth global tactical is up over 2%. When the S&P is actually down over 1.5%. So what's happening is money's coming out of the S&P and out of more equity markets. Those markets are going lower, and safer assets are actually staying up or going up. I'd rather be defensive and protect principal than lose 50% of a client portfolio. So we are being more defensive. Defensive doesn't mean we can't make money. In fact, we are. But ultimately, we're going to get a point in time where the equity markets are, again, relatively strong, and we'll be getting back into those. But right now, we are in a more safe mode. We may get just a tad bit safer in the near term. But at the end of the day, risk management is an important part of money management. Unfortunately, most people don't have that. They kind of buy and hold and hope things go up. Caterpillar came out with earnings this morning, and they were actually pretty good, but I think the CEO is kind of a rah-rah cheerleader, just saying, hey, things overall look good, but then he was worried about maybe some slowing in China and in Europe and all these other things. UPS came out with earnings yesterday, and they missed numbers, and UPS is a really great bellwether of the overall world economy, and they basically came out and they were very much concerned about going into the rest of this year and next year because of Europe and the slow and emerging market economies. So at the end of the day, we're getting a lot more misses than numbers on earnings that are beating, and that tells me that we've got one of the weakest earnings seasons that we've seen probably since almost 2008 from a lot of the early indicators. So at the end of the day, I think what you have to realize is things are slowing. They're not falling off a cliff here, but they are certainly falling off a cliff in Europe. And the emerging markets are slowing enough where it's going to probably drag us down along with Europe. So we are more cautious. and I would recommend, if you're not a client, you may want to take a second look at that portfolio and really decide what you're doing. If you have questions about your portfolio, if you're a client, please call us to the office. If you're not a client and you'd like to become a client, call us if you have any questions. On our radio show on Sunday, of course, because we take all questions on the radio show only for non-clients. But again, if you'd like to become a client, call our office. We'd love to sit down and talk to you about your portfolio and our management. Until Sunday show, make sure you have yourself an extremely profitable week and a safe one. Have a great day.